Right now, artificial intelligence agents are requesting services from other artificial intelligence agents. They negotiate prices, execute labor, and settle payments. The humans involved rarely, if ever, touch the transaction. In a traditional digital economy, humans buy products, hire workers, and pay invoices. Software acts as a tool to facilitate that activity. In this new architecture, software systems themselves are the economic actors. They hold their own funds in cryptocurrency wallets, allocate resources, and accumulate capital without human oversight. This hidden system tracks $22.5 billion across 900 active projects. During the Q1 2026 downturn, while 90% of standard crypto plunged, these AI tokens fell only 14%, holding their structural integrity. We are seeing the formation of a parallel financial system. To evaluate whether it can sustain itself, we have to look past the top-line valuation, audit the underlying infrastructure, the live markets where agents operate, and extreme risks in the code. The foundational engineering problem of an agent economy is simple to state, but difficult to solve. How exactly do you program autonomous software to trust other autonomous software with raw data and real money? The solution required building distinct infrastructure layers. The compute layer, managed by platforms like Render Network, addresses the enormous processing power required to train and run AI models. By connecting hardware owners directly to buyers, it provides distributed graphical processing unit power at rates up to 85% lower than centralized tech providers. Above the compute layer sits the intelligence layer, driven by protocols like Bittensor. Here, decentralized operators provide raw machine learning capabilities and data. The network algorithmically ranks the quality of their intelligence and pays out its native token, TAO, to the top performers. In March 2026, over 70 anonymous contributors coordinated entirely through this protocol to train a massive 72 billion parameter AI model. Without a central corporate coordinator, they produced a complex neural network that achieved benchmark scores, matching proprietary models from major tech labs. Finally, the settlement layer requires a specialized blockchain like Near Protocol. Standard network wait times do not work for software. AI agents executing split-second microtransactions require sub-second transaction finality, the exact irreversible moment a payment is settled. Near handles these confirmations in under 600 milliseconds. The cryptocurrency industry spent the last 15 years building decentralized systems for human trust. And in doing so, engineers inadvertently constructed a perfectly optimized high-speed automated supply chain for non-human labor. That infrastructure routes directly into live markets. Virtual's protocol currently runs the largest active agent marketplace on the blockchain. As of early 2026, it hosts over 17,000 autonomous agents, generating approximately $300 million in annualized revenue. This flowchart tracks their tokenization architecture. When a human investor deposits a specific amount of the native virtual token into a locked liquidity vault, it triggers the protocol to mint a brand new autonomous agent. That investor now co-owns the agent and earns a proportional share of any revenue that software program generates independently. Looking closer at the node level, we see the new ERC 8183 standard at work. This is a universal on-chain escrow system. It acts as a neutral holding account, allowing an agent on one network to securely hire an agent on a different network, only releasing payment when the work is mathematically verified. The engineering is functional, but the financial reality is severely volatile. The majority of agents launched on these platforms fail to generate enough revenue to support their valuations. Currently, over 90% of virtual token holders are losing money on their initial investments. The decentralized ideals of these networks also mask heavy centralization risks. In April 2026, a major operator within the Bittensor network dumped $10.2 million worth of tokens and shut down multiple subnets following a dispute over founder control, wiping out 20% of the asset's price in a single session. We are watching a highly contradictory system operate in real time. It features functional cross-network agent engineering, while simultaneously behaving as an incredibly dangerous speculative bubble. This shadow economy is scaling past the point of isolation. It is now on a direct collision course with traditional institutional finance and established technology monopolies. Wall Street is actively trying to package decentralized machine intelligence for its own clients. Asset managers like Grayscale and Bitwise filed applications for spot exchange-traded funds in April 2026, asking regulators to bring AI network tokens directly into traditional investment portfolios. Meanwhile, centralized giants like Google, Meta, and OpenAI are deploying vast capital reserves to build their own proprietary agent frameworks. They possess superior hardware, highly advanced foundation models, and immense distribution networks. For the decentralized agent economy to survive this competition, it has to offer structural mechanics that tech corporations cannot replicate. That means guaranteeing verifiable code ownership, operating outside of corporate censorship, and offering developers a direct share of the underlying protocol revenue. The timeline is tight. Over the next 12 to 36 months, this highly complex architecture will either stabilize into a foundational digital supply chain, or it will fracture under regulatory pressure and technical failures. The engineering is already deployed. The capital is already moving. If autonomous software can now negotiate its own terms, hire its own labor, and accumulate its own wealth, we have to ask what exactly the human role in the digital economy is going to be.